just while we're in. Hello, Rodney. This we nickname you as Rodney or Dave. I'll be marking the DAX up in the morning for the morning call, or the market call as we call it, because it is on the list. Normally for the Aussie Wonder, but yeah, we'll be going through that tomorrow. If I was to do a full analysis tonight, it would take up the entire hour. Okie dokie. Let's have a look, see if there's anybody in before we start top of the hour. Jeremy, hello my friend. Grant, Bill, pull up a picture. What a great name. And Stephen, hope you're all well. I'm as happy as Larry tonight because obviously I'm technically on my holidays, but I still like to help you guys and make certain that you're on the right track. Hello, Mr. Trading. And that's the plan. So I will be working in the morning, doing the morning call for the guys, just checking off. Going to be off on Tuesday. I'll drop back in on Wednesday morning, Thursday, Friday, all being well. And then you're on your own till I come back. So happy days, happy days. Are my bags packed? No, not quite. The way it works in this house is Joanne has everything prepared sort of from the moment that we book the holiday. Me, on the other hand, I just sling it in a bag 10 minutes before we're about to go. Drives her nuts. But, it's just what us blokes do, isn't it? You're hungover. Too many Budweisers. See, I told you. It's the drink of gods. Drink of gods, my friend. And tonight I've got me coffee. I'm being well behaved tonight because I've got to drive tomorrow down to Manchester. If anybody's in the area, you're welcome to come and join us for a drink. So let's have a look. Where are we off to? I'm going to the island of Sal in Cape Verde. Off to find some sun. I'm absolutely knackered. I know it's bizarre because I do go on holiday a lot. However, I do massive amounts of hours, as you guys know. I'm at this pretty much 7 days a week, and a 10-hour shift for me is a small shift. So I do burn out sort of every couple of months, and I just find a little bit of a break sorts me out. So happy days, happy days, happy days. Evening, Scott. Hope you're well. And that's it. Okay, so I'll have a quick slurp of coffee before we hit 7 o'clock. Well, it looks like we've hit it, so I'm a bit late. Lubricate the throat because I do get a bit dry after this. So, okay guys, what we're going to do tonight is very simple. It's an open Q&A. The idea is I try and answer your questions in plain English the best I can. Housekeeping wise, just wait your turn. If your question's there, I'll try and keep to it. If you use the super chat, it all goes to 𝗖𝗢𝗡𝗘𝗖𝗧, and that question is highlighted and it's given priority. And if I can't have time to answer it, I'll make a point of either making a video of it or answering it in the first live stream. So that's kind of the housekeeping, if you like. So where are we at? So there's a few starting to drift in. So all, how do you do, Carl? Ivan, how are you doing, my little friend? And Emil, excellent. So I'll let you start answering your questions, but in the meantime, I just want to sort of highlight this week. If you keep an eye on the weekend markets, if I flick this over, and it might kind of help Rodney out at the top, about the DAX. Obviously, there's merry hell going on with the various banks and the news that's going on at the moment. If you keep an eye on the weekend charts, so if I flick this over onto the DAX, just because that was highlighted at the beginning of the conversation, and just flick that in, and look at a weekend, drop it into an hourly, you'll start be able to see how it's sort of going to play out over the next day or so. Well, certainly tomorrow anyway. So grab yourself a little drawing tool find out where it closed on Friday night. So that would be that candle there. So it dropped. That shut at that point. It's holding above its closing point. Okay. So is this telling you it's going to gap up tonight? It's highly possible because it's showing a lot of pressure here. All right. So it can give you a heads up and a little bit of an early warning as to what might be going on tonight. And this is, you find it in the weekend charts. The spreads on these things are massive, so I don't necessarily recommend that you trade the weekend charts. However, what you can do is get a gauge of what's happening. Just a little quickie while some of the questions are coming in. So let's have a little look. Grant, I can't see the weekend with my broker. Well, that one's on my IG, but most brokers should have some form of a weekend chart. Now, the way it works on here is it flashes up and you've just got to flick between the two. Or if you give me a second, I'll show you how it works on the phone. Just pull that across. Onto, you go on your phone, it has its own section, which is weekend markets. Okay. Just call up the markets, put the watch lists. There it is there. It'll be in the list as, not sure whether you can see that actually. Yeah. One. Zoom in, you bugger. Yeah, well, maybe he's not. Anyway, it's in the list under the different sort of assets you can trade. But weekend markets is what you're after. Okay. So let's have a little look. Carl, thoughts on volume profile, depth of market, price ladder, footprint chart? I couldn't care less, to be honest, Carl. When it comes to these sort of indicators for me, I find them quite subjective. And in fact, I'll show you for why. Let me just flick this back over, put it onto a normal chart. If we're looking at volume and you see a huge candle come into the market and I drop on a volume indicator, well, all that's telling me is volume's coming into the market. Depth of market does quite the same. So I don't necessarily use them, and I don't use them for this very reason. If I look at that, that's telling me, yeah, there's a little bit of uplift of volume coming in the market. However, I can see it in the candle because there's the upshift here. The next one is red, pushing down, which is greater volume in that. It's picked up pace in the next candle because I can see the tail at the top and I can see a nice fat body. Super volume coming here, and it's all marrying up. Boom, boom, boom. Then it's telling me there's volume coming back to the market and again to here. So when it comes to volume indicators and indicators in general for that matter, Carl, sometimes you can read way too much into them. The candlesticks themselves will tell you what you need to know. Case in point, if I just flick this back just while we having an example, and we can see a little bit of examples here. When you're looking at volume, it's great to know there's volume coming in. But as I've just been saying, a grip big chunky candle is telling you there's huge volume there. If the next candle is not so big, you know the volume is decreasing. And the volume indicator below will just follow what this is. But what it doesn't tell you is what sentiments are. So yeah, that might be decreasing volume. And if I put this volume back on, let's have a little look. And we'll highlight the exact sort of candle. Right, there it is there. That is quite shallow, okay, in relation to this one, okay? But underneath is a massive tail telling you there's a lot of buying pressure inside of this candle. Whereas if you're looking at that volume profile, that's telling you there's a lot of pressure to the downside. Well, the next candle was green. So until this is closed and that's become green, you're working on this thinking that it's going down heavily. But if you looked at the candle makeup is showing pressure to the upside. So that's kind of where I sit. I think sometimes you can overcomplicate the process by thinking, oh, well, the volume's in. Oh, I need this and I need that. Oh, I'm going to add in a moving average. I'm going to add this. The least you have on the chart, the cleaner and safer the chart becomes. And that's because the price is leading you rather than a lagging indicator, because all indicators are lagging, guys, whether we like it or not. And they're derived from the price in the first place. So why not learn how the price works? And obviously we've got levels. We know they respect levels. Why? Because they're built by price in the first place. Then you can have other elements, your dojis, etc. There's something to watch out for. Hammer formation like this, there's something to watch out for. The chart itself can give you loads of clues. So let's have a look, see where we're up to. I've never used IC markets, Grant, so I can't really comment on that. They may well have a weekend market. Might have to flick something on, but I honestly couldn't say because I've never used it. But most of the broker, well, I've only really used sort of IG for decades, so it's always had a weekend market. Quite happy with it. But it is a synthetic market as well, mind. So you've got to be a bit wary of that, which is why I say don't trade it, because the spreads are massive. Anyway, okay. Hello, Jan. Hello, Andrew. Hope you're well. Pull up a picture. Let's have a little look. I may be wrong, but I think I noticed when I had a fid to a recent leg, you use a candle body on the low point and the wick at that. No, not quite. I go wick to wick, but sometimes you'll have, when you're watching me do it, the body may be right at the bottom of a move. I'll show you a thing. Sort of in an instance like that, where it's a full fat body and then moves up. Likewise here, on a move that's dropping down. Let's get rid of this volume profile because I don't actually use it. We'll get rid of all of these levels so that I can show you. If you pull that out, this is the start of a fib retracement. This one here, because you can see the solid drop. And you want the first candle of the move, which would be this one. Well, the tail at the top is incredibly small. So sometimes it looks like it's off the body. But if I was going to draw it, it would look something like this. Down to there and then pull through. Now, the rule of thumb with a fib is you're working on various ratios in order to help you get into the market, help you get risk-free in the market, and then finally get out of the market. For me, it's an ideal tool because it maps out the chart fully. It also shows power shifts, overextended candles, you name it, the fib can do it if you know what you're looking for. And what you're looking for is an absolute stonker of a drop. All right? The harder the drop, the stronger the fib becomes. Now, in a situation like this, you use 0 through to 23.6 in order to find your trade setup. Ideally, in and around or a break of the 23 is the best one, because that means the chart is showing its hand. So in this case, it comes up, picks your order up here. You make certain that you've pulled your stop into a break-even situation or risk-free at 38.2. It's advisable to take some money off the market as well at that point. It'll run naturally to 50% because a strong retracement, 80% of the time, will come back to the 50. And sure enough, there's a solid drop. There's your entries because it's all stalled in and around the 23. And where's the major stall point? The 50. And then if you're looking to run it, you've got your next one, which is the 61.8, and the next one, the 76. But these should be bonuses, money off the table, and letting them run. And if you look when it comes back, it stalls heavily around these areas, slammed right through. But when it pushed up, it stopped dead on the 50 again, came down, stopped dead on the 23. It's a perfect tool. It's, in fact, if I couldn't have anything else, I'd have a chance to just use this. Hope that one kind of helps. So let's have a little look, see where we are. Hello, Liam. RP, naked trading. Well, I'm going on holiday, and yes, I do have the mankini, even though Winky says I'm not allowed to take it. And she said Sally's not allowed to come as well. Well, she get a shot because I've hid it in the bottom of her case. And she's out downstairs and she can't hear me, so that's all right. So what else have we got? So, Kevin, if I was to trade after 6 o'clock in the UK, am I best to look at the DAX, or is there other markets that move between that time? The DAX is pretty darn good up to about 8:30, 9 o'clock. It's not as quick as it is during the full London session, but it's fast enough that it will give you some decent trades. Now, gold and oil will run right the way through that time. Depending on which gold you're doing, if it's spot gold, it's relatively slow and it's better for a swing trade. Whereas if you're using a gold pair, so gold versus the USD, that is ridiculously quick. So you've got to be a bit careful with that one. Likewise with oil, it can be a good shifter as well. You've also got the US 30, the Dow. Now, the Dow is a good market, but word to the wise with that, it's very expensive to get into it, but position down. You know, if you're normally on a pound a point, go in at 20 pence because it is ridiculously fast. And if you're wrong, it'll hurt you. But if you're right, it won't half reward you. So it's a market to be careful with. If you're looking at Forex, cable isn't bad up to about 10 o'clock at night. Same with euro dollar. The Aussie USD comes into play, and so does the US JPY. They become good markets around that time, simply because obviously the US dollar is the world driver. It's very active still around that time when the New York session is running, and you'll be fine and use them. And then as kind of a wild card, it's quite a directional market, but the US CAD is a good market to keep an eye on as well. There is lots and lots of markets. When I come back off holiday, Kevin, I'll trade a few for you guys in the squad, because as you know, I jump on all different times and I just pull an asset up and I show you how to find it. You can always find decent money anytime. Doesn't matter whether it's 3 o'clock in the morning or 3 o'clock in the afternoon. Just look at the asset that's open. And the rule of thumb is you want a central bank that is open at the time. So if you're in the middle of the night, well, your JPY, AUD, the Kiwi, you'll get movement. And that's it, because they are conducting business. So let's have a little look, see where we're up to. I'll get another slurp of the old coffee. Hello, David. Steph. How are you doing, my little kid? Sally's coming on holiday with us, Steph. Winky said no, but I said yeah. So when you see me in the pictures, I'll be the one with the black eye. So, hello, Danny. Hope you're well. Right, Scott. What kind of rig setup will you be taking on your holiday if you're planning? Do you be doing... Well, I'll be in the spa with Winky at that time, because obviously I've got my youthful looks to look after and have a mud bath and a bit of a massage. Although my history with massages ain't good, you know, because I always put my lip up and like tell a joke, and so I don't get like the dainty little girl that comes out that's at the front of reception. Winky gets one of them. I get bloody Bigfoot sister who comes in and bloody splits me up like a pretzel. The last one nearly bloody killed me. So that mightn't go well. But yes, I take a 2-screen rig with me. It's a laptop with a portable screen, both 17-inch, so I can see what I'm doing. Obviously I've got my webcam, and I've got a portable mic that can come with me as well, so I can log on and see what I'm doing. And then all I need to do is take my file from the MT5 and copy it over onto the MT5 on the laptop, so they're completely synced together. And as for my wage account, which is what I do look at, that's web-based, so I can log on anywhere. So that's easy. It's a nice simple way. One thing I don't recommend when you're on holiday is trying to trade off the phone. I get that asked quite regularly, can you trade off the phone? And it's a resounding no. It's fine to monitor your trades. Once you're in, you can sort of see it because you've got a good idea where you're going to get out, and you can kind of look at it and sort of think, it's close to target, I'm just going to close it off. Or you can see it's heading away off to your stop. Okay, I think I'll just close it off. It's fine for that, but if you're going to analyze on the phone, I think it becomes really difficult because you can't see the big picture. Okay, so where are we up to? William, hope you're well. Would you say a price action or candle formation on an hour is more important than what indicated? It's a combination of both. My first primary process is just the candles themselves. I want to see them crashing against a strong level, and the level is obviously being built from the price in the first place. Now, if it's crashing against the level, then there's going to be a reaction. Now, that reaction is called BOB, bounce or break. Now, if it's going to break through, I want to know how it's going to break through, and that's where your indicators come into play. So for me, I want to see what momentum is there. So some form of a momentum indicator. I use an RSI. I find an RSI is very good to show momentum. And if it is predominantly pushing up and it's not overstretched, well, that level mightn't hold. It might break. I also look at a Bollinger Band. Now, again, if it's coming from the bottom, it's broke the moving average inside the Bollinger Band and pushing to the top of the Bollinger Band, but hasn't pierced it yet. Again, that's a good indication that that level mightn't sort of be strong enough, but the one above it might be, because as it breaks through, it's going to slow it down. So where's the next momentum shift? It'll be the next level. So I'll be keeping an eye on a Bollinger Band to see if it pushes out. If it does push out of the Bollinger Band and the RSI is stretched at the same time, and these are on hourly charts, by the way, guys. I don't read a trade idea below that. Then there's a fair idea this level might be sort of strong enough to hold the price back. Well, if it is, then that level becomes a good entry point, and then you start looking down in your lower time frames, your 15 minutes or your 5 minutes, to look for an entry criteria. And in sort of the example there where I showed you a fib, this is an ideal situation, because if you've seen that shift up into a level, the level didn't hold, and you could see the RSI's pushing up and the Bollinger's pushing out, and then it goes up to the next level but stalls, then that's a good indication that that move is probably finished. And then that's backed up with the Bolly, it's backed up with the RSI. Then you need to measure it out, draw your fib on. You know where your entry criteria is, where it's going to show its hand. As long as it doesn't break the 0, comes down to the 23, well, then it's off to the 38, off to the 50. But if you've got the level prior that you saw it burst through, that can actually become a good target point. So the chart tells you everything you need to know, just by looking at the basic stuff. Now, one of the worst things is to try and overload too many indicators into the situation. All that happens is you cloud your judgment. So happy days, happy days. So let's have a look, see where we're at. Message by Shashwash. Not rightly sure what that means, Andrew. If you elaborate, I might be able to answer, but don't know what that is. Don't you worry, Steph. She'll be there. She'll be there. She's pining for yours. I think Finney's bringing his to the Holiday Inn tomorrow. That'll be interesting. Anyway, did I make any money from the bank movements last week? Well, I made money off my normal wages and one thing and another. However, I did have shares running last week, and I lost money on it, believe it or not. But that's just nature of what we do. They are longer term swings, and obviously it came down, stopped out, not a problem. The account's still running, it's still in profit, and when my year end comes at the end of this month, it will be up reasonably well, so I'm quite fine with that. But just because something's gone down doesn't make it say it won't go up. So it's actually a good opportunity to start keeping an eye on these things, certainly as the markets calm themselves down. So let's have a look. More like 𝗖𝗢𝗡𝗘𝗖𝗧. You're not wrong there. You're definitely not wrong there. You're struggling with a 13-inch MacBook. You'll be fine, Grant. You'll be fine. I made 3. I made 4. Any advances? 3 grand. Oh, well done. Well done. That's what we're always here for. We're here to sort of extract as much as we can out of the markets, but do it in a way that's safe, though. And I do stress that, because when you've got violent times in the markets like what they are now, you can make money very quickly, but you can also lose money very quickly. So sometimes you've got to be a little bit careful. Okay. Makes perfect sense. You're very, very welcome, William. You're very welcome. So let's have a look. Do you have a quick way to explore? Well, yeah. There's different ways you can do this. Now, I have fixed ideas of how much I'm willing to pay for a trade. Excuse me, I just need a drink. I need to lubricate my throat. It's getting dry. I've been speaking all day. I work on a formula of 50p for every 500 or 10 pence for every 100 to have a maximum position size. But then I also have a maximum week allowance as to how much that I can spend. It's kind of a risk profile, if you like. And it's 10% of the account. Now, you might bulk at that and go, 10% of the account? Are you mad? Well, that's 10% across a week. So £100,000 account. I have 10 grand to play with a week. Divide that into 5 days, gives me 2 grand a day, which is 2% of the account. Now, that's a quick, ready reckoner. Now, if I lose 2,000 in the first trade, I can't trade anymore that day. That's it, I'm done. So, am I prepared to put that much on the table? No, I'm not. So, the first question I always ask myself is, how much is this going to cost? And that's how I do it. When you start getting into the mathematical gymnasts of some of the way, well, if I'm putting 0.5%, 0.25% of my account up, the lot size has to be this based on a stop of that, I think it becomes too confusing. And then you start working into risk reward, and trust me, it never works. Not in the long term, because your trades are never identical. So I prefer to work with the same position size. I'll start my at the moment I'm up to about 25 quid a point. I don't want to go much more than that, which for people who trade lots, it's 2.5 lot. Now in April, I will be increasing that because I need a pay rise, but also last year I've done incredibly well and my account is that little bit bigger. So I can now take a bigger position size. So that's kind of the way I do it. It's a quick ready reckoner in my head. You've got a £2,000 account, you're £2 a point. Okay. How far is my stop? Well, my stop's 40 pips away. Well, that's 80 quid. Am I happy to pay 80 quid? Well, yes, good. I'll go with the trade. No, right. Well, it's obviously too big a position size. I'll half it. I'll put £1 a point on. So stop stays where it is at 40, cost me 40 quid. Am I happy to pay that? Yeah. And that's it. Job's done. Then on the other side of it is your profit. The profit is just what you get for doing the job. If you try and combine like an old way of thinking, and I'm quite controversial on this because I get shot down in flames all the time for saying it. If you think you're doing your 1 to 3 risk reward because that's the way it is, you're wrong. Because your stop has one job: protect the account. That's it. Has nothing to do with the trade. It is there for one purpose: protect that account. Your profit is your reward. Now, I work on ROI, so if I get a 10% return on my profit, I'm happy with that. If I get 50% return, I'm ecstatic. And that's how I think, because I think you should go into the market fully prepared to win, not fully prepared to lose. Because if you go in thinking you're losing, you've already lost. And then look at it from another point of view. Who tells you this? I mean, think about it. Who tells you all of this? It's all the educators who want to deal with you on one thing and another. And why? It's the easiest sales pitch in the world. You're shit at your job, but I'm going to pay you. That's my take on this. And that's because I come from a business background and I think completely different. I didn't come into this the way probably 80% of the people in this room came into it. You know, you'll have seen it and maybe thought it's a good idea. For me, trading was my job. And I was taught from an ex-commercial bank manager. So my way of thinking is the way he used to think. It's all about return on investment, ROI. So I hope that makes sense. Genuinely do. It's a strange subject, that. It's I'm not rightly sure how to answer it, to be honest. I think one of the easiest ways to do this, if you are going down the route of 1 to 3 or 1 to 2, whatever, is you have to work with fixed stops and fixed targets. If you are variable, it'll never work, because what will inevitably happen is you'll win the small winners, but you'll always lose the big losers, and they'll balance out and they'll just wipe each other out. But if it's fixed, I'm always going to market with a 50 pip stop. I'm always going to go with a 100 pip target. Then it starts becoming viable. But if you're varying your trades from time to time, it'll never be viable, because there's too many moving parts, and that's it. So I hope that one makes sense. Oh, it does. Excellent. Saw that. So keep your questions coming, guys, because still got half an hour. Otherwise, it'll be very quiet, because the way this works is I react to what you guys ask. If you ask me a question, I'll answer it best I can. You might agree with me, which is fine. I'm just sort of trying to give you some experience that I've come across. And the one thing, I kind of touched on it in Coffee with Scruff, and I'll kind of tell you this while you're thinking about it, about success. What is the measure of success? You know, is it the amount of money you make, or is it the fact that you are consistent? Now, to me, I think it's consistency, which means that there is, you're doing your job correctly. So that's right. I'll get to that. So that is my level of success, consistency, which means win rate. And the higher your win rate, the better you are at the job. If you're still losing, but you've got a high win rate, then there's something wrong with your stops. So that can also highlight certain things. So let's jump back onto the chat, see what we've got. Where is the news heat map you look at? As in, right. Oh, okay, hold on. Well, the one I mainly look at is FinViz. Give me a second. There's actually two that I look at. I'll show you them both. There's this one, which is investing.com. I think most of you will be familiar with this one. It's very good. You can look at all your technicals. You can get a technical summary of pretty much anything you want to look at. You can drill into it. It'll give you the news. You name it, it's in here. And you can just find whatever you want, drop on the home page. Very, very simple website to use. And there is loads of different bits and pieces up here. And again, you just go to there, look for latest incoming news, and there you go. And you've got a squawk box. Nice and simple. Now, the next one, I just pop this up here and come down, is this one, which is FinViz. And again, just flick it onto there. You've got a good squawk box of what's going on. And then if you want the heat map itself, flick that across. That'll give you a heat map for the marketplace just as a quick snapshot. Very, very, very simple. Very good website and handy to have. But when you're day trading, don't get too bogged down on the news. Just be aware of it. If you know that there's going to be a major news announcement coming, be aware what time it is, and either make certain that you are safe in the trade or you're not going to trade it at all. Let it do its thing, then trade afterwards. Okay. So, right. So Scott, how long before the news would you be out of the market? Roughly about an hour. I find it hard to judge. You've noticed markets can be pretty choppy late in the afternoon. When it comes to news, if there's going to be a high impact, now high impact news, I'll show you where the economic calendar is that I use for that one. That is this. If you come onto this website called Baby Pips, you go onto the calendar, click the day that you want to see. Obviously it's Sunday, so there isn't anything, so I'll flick up for tomorrow. It will give you a list of all of the economic news. Now tomorrow there isn't really any, it's just medium impact, so there's not a great deal going on. And then if we flip into Tuesday, what I'm interested in is these, the ones that say high impact, sort of here, and it'll tell you what time it is. Now these times for me are UK based, but if there's a high impact, I'll be out an hour, 45 minutes before. I don't want to trade into it because the markets will be setting up for it. And then afterwards, I'd like to see, unless it's something like a major interest move or non-farm payroll where I'll actually trade the event itself. I don't advise it, by the way, guys. I just normally do it for the guys in the squad because they gored me. It's normally little Hobbit there having a pop. But on normal circumstances, I'll let the first half hour rattle its way. So if the news event comes out at 12:30, I'll sort of look at 1 o'clock, which lines up with how I trade anyway, because I look at the top of each hour to get my trade idea, and I'm binary with it as well. What I mean by that is at the top of the hour, I'll look at it and I'll go, well, I'm looking at these three markets. Don't like to look at really more than three at a time. Is any of them ready to go? Yeah, 2 of them are ready to go. Which is the best of the 2? It's either that one or that one. Well, it's that one. And then that's it. I go. But if none of them are ready, then I wait another hour. And I do that over and over. Keeps my win rates incredibly high because I'm only zooming in and focused on a limited amount of assets per day. And then I zoom in to one asset. And then I'll monitor it and I'll watch it. And I'll go into it when everything lines up. Happy days. Okay, so where else are we up to? Do you use massive leverage accounts? I do have 500 to 1 on Black Bull. But what I'm going to what I'll say about leverage is, it's a little bit like the prop funds. Don't be taken in with huge prop fund figures. I mean, it was well known. I mean, I was doing my prop funds and sort of there's certain things you sort of keep private, but it was into multiple hundreds of thousands. Sounds fantastic, but it's not, because the account is that big, because it's only based on the drawdown. It's only like 4,000. So if you've got a £200,000 account, you think it's amazing. It's only about 8 grand, 9 grand. It's not a lot of money. you know. So what is it? Well, the account is buying power. That's the leverage. It means I can open any asset that I want. It doesn't mean that I can up the position size. Now, when you got 500 to 1 on Black Bull, the principle is exactly the same. It just gives you buying power to open up an asset that you wouldn't normally be able to trade on a small account. You know, take the DAX, for example, that we've been looking at this evening. It's quite an expensive market to get into. But if you've got the leverage, you can open up the position. The trick is to base the position on your physical money. So if you've only got 500 quid, well, it's a 50p position. You know, it'd be stupid to put £5 a point on it just because you've got leverage for it. So that's all you use leverage for. It's just buying power to open an asset. Your position should always be based on your physical money. Because again, to me, that's just common sense. So I agree with you, Pull Up. It is incredibly dangerous if you don't know how to use it. For me, it just means I can trade whatever I want. You know, if I want to trade the US 30, I can trade the US 30, but I'll be at 10p a point. You know, I'm not going to put £1 a point on it and wipe the account out in a heartbeat. So happy days. Would you take a look at from last week? I'm a bit lost when I was drawing fibs. Let's have a little look. So let's have a look. Okay. So if we look at what time frame we're looking at, I'm going to assume it was the hourly. Okay. This leg is not finished, but this one was the last completed leg, which was the 15th. So day was the 15th. So that was Wednesday, was the last solid pulse that I can see. If I'm drawing a fib, it would have been on this one, from the base of there up to there. And that is there. You can see the shift. It was a sustained move. Red candle showed the end of the move if you were going to draw the fib. And then this one here came down and triggered in. Yes, it went up. You would have took on a little bit of heat. But this kind of illustrates something that we were talking about earlier on about using indicators. There's the drive running up. It's burst outside of the Bollinger Band, showing you that this is going to lose steam, because that's what happens with the Bollinger Band. If it's on the outside, eventually it's going to run out of steam. So you look for other elements to sort of back it up. Well, there's the end of the move, and it's red. So you wouldn't really necessarily do anything. You can't move the fib because it's not breaking the top. This one closed inside the Bollinger Band, giving you another idea as to the fact that this is slowing down. It's also incredibly stretched down here. So yes, it's slowing down. Giving you the thing. It's pushed up. Well, there's my stop criteria. I have it between the 127 and the 161 based on the move that's running, and I want to see 2 swing points. Well, there's one, there's another one. So there's 2 swings that I can see. And then I'll be targeting down into the 50%, straight in to the pip, 50%. Very, very simple. But you can't just draw a fib willy-nilly. There has to be a catalyst, something that is excessive. And that's why that sticks out like a sore thumb. You'll have had 1, 2, 3, 4 hours to recognize that. And then you've had 2 hours to draw that fib in and make a choice. Simple. And then if you are going to stage it, well, you stage it all the way up into maybe halfway into there, which is what I would have done. So it would have picked up a couple of orders, maybe 3, might have even got into 4, and then straight down into 50%. And that's kind of the way I would have looked at that. So that's what I would have done. So let's have a little look, see where we're at. So leverage account are not dangerous for you. Well, you're right, Grant. Most people do use them wrong. Can one pass the 5% bootcamp trading daily? Definitely. You could pass it trading any. With the daily, you would get bigger moves. So you might be getting 30, 40, 50 pips across 2 or 3 days, which is equal to 10 pips a day. The way you pass a boot camp is break it down into daily bite-sized chunks. And then you just work out what your rough average pip count is. It's 20 pips. You can easily get 20 pips off a daily candle. It's quite easy because you've got plenty of time to look at it. You know, that's one of the fallacies. Everybody seems to think the further down, quicker the chart, the more you make. It's actually the other way around. The higher up the chart, the stronger your signal becomes. You can also see better points of entry, because a 5 minutes going to dance around. A 1 minute will be all over the place. Once you've got your idea, look at a 1 minute chart if that's as low as you want to go. But if you're taking the idea off a 1 minute chart, yeah, I'm telling you, you're in cuckoo land, because it won't show you enough information. It'll be too jittery and it'll scare you out of the market, and you'll get quick bursts, and you might do well for a couple of weeks, but eventually you'll get a good hard slap in the face, and bugger me will you know about it. Certainly on something like gold or the DAX. So yeah, so in answer to the question, yes, you can use a daily. So where are we at? So I struggle to find trade direction bias. When I trade, it never goes against me. Right, okay. You can trade both ways. It doesn't really, well, in fact, I was kind of case in point. That's pushing up, but the trade itself was the opposite direction, because the criteria was there for it to move down. Now, in this situation, the whole market as a whole is moving to the upper side. Now, if we flick this through, you can see it. You can see that it's moving up, but the market moves in waves, and you've got a wave down, you've got a wave up. The trick is your targeting. You know, you have to be conservative with your targeting. Now, I work on extremes of the markets all the time. You know, I want to see stretch points. I want to see if the momentum's about to run out. Then I want to see it crash against a level. So mapping the charts out is very important, and that's what I go through quite a bit with the squad guys. They know I pay absolute attention to my markings up, and I do it in quite a unique way just for those guys. It's not something that I really share publicly, because it took time to work it out. But if you can sort of mark your charts up correct, your direction then doesn't become that important. What comes important is the formation of the candle and where the bounce point is. But then also look at your ATR and use that to have a sensible target. Case in point, you have euro dollar, which is roughly about a 90 ATR on sort of reasonable days. If you divide that by 3 and you use a multi-time frame analysis approach, in other words, look what the daily's doing, look what the 4 hours doing, look what the 1 hour's doing. Are they in alignment, all in the same direction? Well, if they are, well, then you're going to be targeting that direction, and you've got the wind in your sails. You can target a bigger target, which in this case would be 30, a third of the ATR. Why a third of the ATR? Because you're not going to get the bottom third. You're not going to get the top third. You'll get the bit in the middle, which is 30 pips or there or thereabouts. Now, if you're going against it because you think there's going to be a half decent retracement, a little bit like the fib that I've just shown you in gold, then third that again. So your 90 is divided by 3 to give you 30. Divide the 30 by 3, because what you're working now is the intermediate wave, and it's the same principle. Not the top third, not the bottom third, the bit in the middle, and that'll give you a 10 pip target. Then you work on the fact that, well, I want a reasonable target per day. Now for me, if I don't get 10 pips, I don't really trade it, not really. You know, if I'm in the Asian session, then I'll drop that down to 5 pips because obviously it's a bit slower. And sometimes after 7 o'clock, going back earlier when we're talking about decent markets, it is a little bit slower than London, so I might calm that down to 7 pips. It's about targeting appropriately, guys. So there we go. So where else are we up to? Scruffy Madness for trade. I use Scruffy Madness every day. You guys in the squad know that, and you know that I'm a lover of it. And why? It's common sense. It gives you a better price, reduces your exposure, increases your upside, and it's based on a process, not money. Because the number one thing I'm asked all the time is, well, if your first position runs, I'm losing. Well, you've already lost because you've asked that question in the first place. You're not following the process. And I'll be brutally honest, everybody that's here publicly, if you're chasing money, give this job up. McDonald's are hiring and you'll get paid more. This is hard. It's not about the money. It's about the process. Get the process right. The money looks after itself. If you chase the money, you'll bugger the process and you'll gamble. Gamblers never win. So it's probably the best advice I can give you. So there we go. Happy days. Where else are we up to? High leverage is good for scalping if you have a high win rate. No, I would disagree with that, David, because that again is going down this. Let's push the position size up because I've got the capability. You can have a high win rate, but if you've got a huge leverage on and it goes the wrong way, all your good work's gone. All leverage is for is buying power. If you start to use it to up your ante with your position sizes, tell me I'm wrong, but I've seen many people get burnt, and no, it's only there to open an asset. Doesn't matter whether you're a scalper or a swing trader, really doesn't. Nick, Invis is free, good enough? No, just the free version. Don't need to subscribe to it. The actual scale as well, that's on the heat map telling you the strongest to the weakest is ideal. Just to give you a quick snapshot of which products are good on the day, and why not? It's free. Use it. No worries, Kathy. Evening, Rory. Hope the little one's in bed. Right. Do you have any book recommendations on technical analysis? Yeah, the Rough Guide, Steve Ruffley's book. It's pretty darn good. He's big onto fibs and things like that, and he's a top guy. Grant, 1 in 30 leverage on a DAC, and I still trade up to 50. It's fine. The DAX will actually pay you very, very well on 50 pence because it moves that brutal. And it's horses for courses, guys. If you've got a small account, don't over-egg it. If you over-egg it, you're going to blow it. And once the money's gone, it's gone. It's game over. So there we go. Went out to a 1 second chart. Whoa, you brave son. I think my head would explode at that point. I like it nice and easy. I'd like it nice and easy. I'll drop it into the squad, Rory, because obviously that's for you guys. It's dead simple though. I set it up the same way. Give us a second. If you get a, I hate this. Get another one. This is that stupid. It's horrid. Let's get that off. Switch this off. It's absolutely awful, this thing. And for those of you who don't use MT5, this is why. Right, there we go. There we are. I have it laid out like so. So it breaks everything up. So this will give me 5 measuring points. If you look in the library under Madness, it shows it fully. But it's position 1, 2, 3, 4, and 5, and then out. Very, very simple. And you just put it from one point to the next. In other words, your entry 10 pips below your stop, and it'll measure it out perfectly. And you use a fib extension. Now, on this one, works the same way. Draw it in, get my extension, and you would just pull it from one point to the next. And again, I've got it laid out exactly the same: 0, 25, 50, 75, 100, 1, 2, 3, 4, 5 points, and then out. Dead simple. Okay. You're very welcome, Andrew. You're very welcome. Let's see, Nick. Yeah, welcome. Yanis got, he did. He's come a long way, Yanis, from when I first met him. Don't worry, I still keep eye on him and point him in the right direction when he needs it. But he's flying high, that kid. He really is. He's flying high. But we all get caught. I mean, I was open about it the other week. I mean, I popped the small account that I was running because I put the wrong position size in, and it's just one of them things. You just bang. Even I make mistakes, but I hold up to them. You know, did it, lost. A few weeks before that, you'll have seen the Thursday trade. I got it horribly wrong, and it cost me a bit of money then as well. So happy days, happy days. So where else are we at? You're very welcome, Rory. You're very welcome. I've never really used Seed Trader. You never know. I might look at it from time to time. No, they don't. It's MT5, Rory. But I've kind of got used to MT5 since sort of using it, and I don't mind it. I find it a bit clunky from time to time, but on the whole, it's not bad. So might be a daft question, but on ICT the markets are 8 AM to 8 PM stead. Excellent. But it's the same across the board. Once you go out of market hours, the spreads go a little bit mental, but they pull back in again at midnight when the Asia opens. There's a couple of hours where they just go nuts. Even tonight, one of the things that I say is don't trade on Sunday night, simply because the spreads are huge, absolutely huge. You're welcome, Rogue. How are you? So let's see where we're up to. Pepperstone, again, good. Switch that off. Well, it's just my job, Kevin. That's all. I can only show you what I do. I can't promise you a magic pill, and I certainly won't. Can I show you the path? Yes. And the guys in the group will tell you. I've turned people down the right road, and they're now doing very well. And I'm proud of the entire group, really am, because they are all pulling together. So happy days, happy days. So where are we up to? But I never do this and blame losses on T5. We'll touch on losses just for the last few minutes of the hour. You shouldn't blame anything but yourself. It's very easy to pick fault and go, oh, well, the market was hunting me out. It wasn't hunting you out. The market doesn't even know you're there. All it is you're playing, it's the highest league going, but you're playing against professionals who are better than you. And if you can see something in the chart, I mean, common sense is going to tell you they can see it as well. And if they have the power to move that chart, they are definitely going to take you out of the equation. And why? Because they can. It's just the nature of their job. They want better pricing. They have to sort of build up liquidity in order to fulfill orders. And you'll hear sort of certain terms like liquidity draws and one thing and another. I don't subscribe to any of that really. I stick to it simple. You know, it's your levels. It'll pull to a level. Why? Because there's a fair chance that's where business is going to take place, because it's happened before. But when you start going down the route of, oh, this is an order block, this is a liquidity pool and everything, unless you can actually physically see those orders, you've got no idea. It's just a hypothesis. So what happens is when the market inevitably pulls up to the level or going to try and test a swing high, you say the market's out to get you. It's not. It's just the market doing what the market does by people with a lot of money using their money in a good way, knowing that there's probably a lot of stop orders in and around that area. And therefore, if there's a lot of stop orders in that area, they can use that to their advantage. And that's where, again, coming back to a lot of what you're fed, you know, we spoke a little bit about risk rewards and all of this. I don't subscribe to any of it. You know, I think it sets you up for a fall. What you want to be subscribing to is understanding what's going on and try and think like a chess player 2 steps ahead. If I had the ability to do X, would I do it? And if I would, how far would I push the market? And that's where your Bollinger Bands and everything show you, because it will show you which one of the levels is going to stall. But then you still want to be out of the noise, because if you've got a tight stop, you've just invited the market to take it off you. So sometimes you've just got to look in the mirror and blame yourself. The market is not out to get you. So let's have a look. See where we are. Well, I've looked at it, and it's not really new. Fair value gaps is nothing more than an overextended candle. A fib will show you that. And when we talk about liquidity draws, discounted premium price, all of this, well, it's the age-old thing. You sell high, you buy low. Do I like it? I didn't really pay it much attention because I'm happy with the way I trade. All I'll say is there's a lot of holes in it. You start drawing up fair value gaps, they're everywhere. When you start talking about liquidity draws, they're everywhere. Because you go, oh, it's going to come up to this pool, right? Fine. Well, what about the one behind it or the one behind that? You've got to get your direction right. Your direction is king. Get the direction right, it'll forgive a bad entry. If you're sort of going, oh, well, I'm in a discounted price, I'm in a premium price, that's fine. But you've got to understand why it's there in the first place. I don't know. It's not for me to say whether it's good, bad, or indifferent. All I'll say is if it works for you, fantastic. But I know what I do works. It's worked for me for a very long time. And not only has it worked for a very long time, I haven't changed the style of it either. It's exactly the same as what I was doing sort of 7 years ago. Markets work in cycles. We touched on this. The way that I trade is battle tested. There's a lot of strategies out there, you see. It's often from young kids who come into it and they'll repackage something they've seen, but they haven't seen a market cycle, and we're about to go into one. They've never been in black swan bear markets, and trust me, they are fucking vicious. They really are. A lot of people don't know where the term long comes from and where the term short comes from. This might give a good idea. It takes a long time for a market to build up momentum to move up. You are going long. But when a market starts to sell off, it takes a short time for it to get down. It's why when you look at the markets, you see it going up in stages. You go up the stairs to build a market. You use the elevator to come down, long and short. Okay? So if you're looking for strategies, just make certain that you're comfortable with it, and then just go through battle testing. But there is a caveat to that. That's only for swing trades, because a day trade doesn't matter what the market is, whether it's a bear market or a bull market. The market will go both ways on a given day. The key is your target. Pay attention to your target and target responsibly, and you'll be fine. Let's have a little look. Last few minutes, and we'll pick off the last of the comments. So where we are. So so awesome, mate. Debating whether to start learning to trade or wait a few weeks. Well, you can trade any time, because go to Baby Pips, the site where I showed you for the economic news. Inside of that, there is a course, educational course. It's as good as any paid course, so you get all your fundamentals at that point. You can open yourself up a trading view account. Doesn't cost you anything, and you get a feel for the charts and just sort of paper trade for maybe 30 days or so and get a good feel. And then when you're happy with that, don't enter into the market. Just do a 30-day challenge and go, right, I've got my fundamentals. I understand roughly what I'm looking for. I'm going to battle test it. And the battle test just means you're going to go into market that's live, not back testing. Because back testing is okay, but the problem with it is you're always looking for the perfect setup. When you go on battle testing and forward testing, you don't know what's coming. So you have to see and take the blows as it comes. And that's where your itchy trigger finger comes in, your emotions take over, all of this sort of thing. Because when you're already on hindsight, in other words, back testing, you can go, well, I'm definitely getting in on this candle. The question is, would you do it if it was in front of you? And that's where battle testing comes in. And the way you do a battle test is you trade once a day on one asset for 30 days. And if you are positive expectancy at the end of that 30 days, in other words, you stuck to one trade, one asset, and you had more pips than you started with, in other words, you start with 0 pips and you end up with a positive expectancy, then you've earned the right to trade. And I would recommend trading another 30 days, just paper trading, getting a good feel. And then when you're happy, you move into a small live account and then move it from there. And if you think about it, 60 days for a lifetime, it's not a long time at all. Okay. Paul, I honestly think Scruffy is better than I said. Well, that's very kind of you to say. I wouldn't like to say. Right. Grant, I'm an ICT trader and I like Scruff. It's very kind of you. I like you as well. There's nothing wrong with ICT. It's just a different style. In some regards, I'm a little bit arrogant on my own. But, well, I wouldn't say arrogant. I just like what I do, and I know it works, so it's the age-old thing. If it ain't broke, don't fix it. And I've been around the block that many times. I've seen so many strategies over the years. They look great in hindsight, but in reality, when you go into the markets, it's a different kettle of fish. Now, there's a lot of the squad guys in here, and they'll tell you, and do say this in the comments, guys. I'll tell them what I'm doing before I'm doing it, but I'll also tell them why I'm doing it. This is the chart, this is the level, this is the parameters that I'm looking at, and this is what I expect. And then I do it. It's very difficult to do that before the event, but it's very easy to do it after the event. Hope that makes sense. And that's kind of what I do. So happy days, happy days. Hello, Dwayne. I'm jealous of you. In fact, I hate you. I do. I'm going to fly over to Hawaii and I'm going to spend a week in your house and I'm going to drink all of your beer and I'm going to rag your car just because you're going to live in Hawaii. I'm so jealous because it is horrible here. But I'm going to the sunshine tomorrow because I'm on holiday tomorrow. So fantastic. Great to see you, Dwayne. It really is, Don. Rory, how are you doing? Once you realise you're responsible for your own losses, it makes the mindset much easier. Correct. Now, when you're coming into that kind of situation of realising your responsibility, that's when you start to grow as a trader. You are the master of your own destiny when we trade. The problem is we do trade from a high level of emotion when we first start. And a lot of new traders, they're up to like a dial of 8, 9, and 10, or even further, yeah, you know, and it's just wrong. You know, when I'm trading, I'm down at sort of 2. You know, I still have emotions, but it's not as bad as it seems. And that's because I am controlled with my losses. If I'm going to lose, I'm going to lose, and I'll just accept it. You know, and that's it. It's just part of the game. So where are we going? What's a good level to join the group? I did a video today, Patrick. Have a little look, but ask the guys in the Telegram. They'll tell you. Crypto, no. It's I had a go at it. I really don't like it. I find it a bit like the Wild West. Way up, there's Jordan. How are you doing, my kid? How's the weather over in Aussie Pot? Jealous of him and all. I'm going to fly over to his house and kick him up the arse because he always has sunshine outside and all. So, happy days, happy days. Grant, greed and patience. Yeah. It's the age-old thing. Your patience will get you through it. Your greed will destroy it. And if you can master them, well, then you are on the right track. Happy days, happy days. Then go full sots. Bang on, bang on. The following band, you moderate. No, Bollies, I just use standard. 2 deviations, 20 moving average. As good as any. But what I suggest is you don't look at it below 1 hour. Once you start going below an hour, that's when the indicators start becoming a bit haywire. Don't be too reliant on indicators. As we were saying earlier on, you know, your price will tell you what it needs to show. You know, show your stretch points. You'll see the wicks. You'll see the bounces on the chart. Once you go down into the 5-minute chart and you've got your Bollinger Band, yeah, it's going to show you stretch points. But it's just the market moving up and down anyway. So just keep them simple. 1 hour is as good as it gets. Standard settings. Happy days, happy days. So, yeah, cheers, Ivan. Very, very kind of you to say so. Danny, I do my best. I do my best. Right, in Fib we trust. In Fib we definitely do trust. And I trust that every single day. All right, Steph, vouch for Scruff. Good lad. I like you. There we go. The boys are in. Happy days. Happy days. Glad of that. Unconscious confidence. It's creeping into yours since you've been in the spotlight. Do you know what it is, Jordan, on that? I sometimes think, and I have this as well, you can almost call it performance anxiety. When you're doing a live session, you actually want to show the guy something. And if it's not there, you can almost force it to come into it. And then you sort of think, shit. Then you've got to step your game up. And it becomes quite difficult and stressful. I don't know if you found that, but I've certainly found that. You definitely want to show the guy something because it's there. It's in the moment. But it might actually tick all of your boxes. And then it becomes a problem. The good side of it is when you can sort of look at it and go, well, it doesn't tick my boxes, but this is why. And then you can just let it run. Just a thought. Just a thought. Yes. I'll be in the squad first thing in the morning. Doing the morning call. I'm leaving here about 10 o'clock tomorrow morning. Be in Manchester at around 2. There overnight, so if you want to drink, by all means, drop by and I'll buy you a beer. And then I'm off for the sun. Happy days. So it's been good tonight, guys. I've really enjoyed it. I hope you've sort of learned something or thought I'm an idiot. Either way. It's good. But let's have a look, see what Jordan has to say for the last part. It's an element completely break. You're right, kid. You're definitely right. And when you get it to the point where you can do it subconsciously without thinking and the process is on point, that's the holy grail. That genuinely is. There's no holy grail systems, guys, but there is a holy grail mindset. And if you check out Jordan at Traderlicious there, you'll see him with an interview with myself and him. He's a top boy. What he's touching on is quite right. When you can do it as a process, just like that, you've snapped it. You really are on crack. Oh, I keep telling you you're aware of it, kid. You'll be all right. Okay, boys and girls. See you all in the morning. Need my beauty sleep. And happy days. So as always, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all later. You're cool. Don't you worry, kid. Don't you worry. We do it every other Sunday about 7 o'clock. Happy days. Catch you soon. Bye.